what we've been noticing, everyone, is that Zoom is on fire in terms of, you know, the people using Zoom. It's taking longer for us to process our videos as people who rely on Zoom. You know, Joel, Dan, and I use Zoom with our clients all the time. So that's one of the things that we're going to talk about today are companies that are thriving, you know, with what's going on. As you probably are experiencing right now, you're going to your supermarket and you're seeing empty shelves where toilet paper used to be. Dan told me a story about shopping. He was shopping in, Dan, maybe you could take yourself off mute and you can tell about the guy that pummeled you for your
pummeled. They're not pummeled, but like there was just frantic. I mean, I'm in San Diego downtown here, like right downtown, and you get some interesting characters downtown San Diego, especially, you know, during this panic in the grocery store. And I had the last 3 isopropyl alcohol wipe packets because there was nothing else left. But I better get something to disinfect my house with. I'm disinfecting my house with these little things this big. But a guy approached me and offered me money for one of them. And when I said no, he'd be, "Oh, you're an asshole," and he like stopped away. Interesting experience to say the least. But
oh, people are crazy. And you know, we have a market. I'm looking at, you know, the futures for the S&P right now. We're down like 93 points. So you have a market that's swinging, you know, up 1,000, down 3,000. And we're here to tell you that, number one, there is a way to protect your accounts. There's a way to be in a portfolio that is a little different than most people are in portfolios, and also opportunities for some short-term moves that will be super, you know, profitable for those of you who, you know, wrap your mind around what's available. So what we do here every week, each of us has a little piece that we want to share. And ideally, if you love what you're experiencing today, we have an offer for you to work with us and learn with us in a deeper way. And we'll talk to you about that. So my idea, guys, that I'm sharing today is how to look for some short-term opportunities based on today's environment. How do we limit the losses of owning the stock in those opportunities? And if we have a belief that the asset will moderately rise in price, you know, the example of Zoom, right? So Zoom, I'm going to show you the chart. I don't know where they're at today. Yesterday, I looked at them. They were at 111, but they had highs into the 120s previously. So why is this a great strategy that we're going to talk about? Because we are in volatile times, guys. Are these volatile times or what? If anybody wants to unmute yourself, maybe Joel, you could talk about the all-time high that we're seeing in the VIX, and maybe you can tell people, you know, what the VIX is just very briefly and what the all-time high in the VIX means.
Yeah, so volatility is just how much a stock or a market is moving up or down. And the VIX measures the volatility of the overall stock market movement. So historically, we've had very low volatility, 10, 20 or so is the normal index. And the high before last week or so was in the global financial crisis we had in 2008-9, when the VIX reached 80. And there's a lot of different measures of VIX. There's a short-term volatility, there's medium, long-term volatility, there's measures for stock market, there's measures for bond market. But the one I'm quoting is for the stock market, and the measure hit an all-time high just a couple of days ago, and then today it looks like it's hitting an all-time high again. So you haven't seen measures of this kind of volatility. I guess the market was down 12% on Monday after being down 10% last Thursday and up almost 10% on Friday. So even during the financial crisis, when I was managing money for Citigroup and I was managing about $300 million that year, we didn't see these kinds of movements. And so to take advantage of this volatility is what we're talking about.
Yeah, and which is a great lead-in to what I'm going to share. This is our little legal notice. You guys I just want to go on record here that we are not telling you, we're not giving any advice here. We're not saying that, you know, if you follow what we're talking about here, you will profit 100% of the time. There is risk in the markets. And certainly, if you have an opportunity to take anything that we're talking about here, and if you want to seek advice from an independent financial advisor, you have the opportunity to do that. That's not what we do here. We are not financial advisors. We have financial passion. We understand the markets. We're understanding them better and better every single day. And that's what we want for you all to be able to do, to be more self-directed and to take control of your financial destiny. So talk about how people can profit from the VIX. Here's an article that I came across yesterday from Market Insider. A Robinhood trader, there's an interview in Market Insider, and you guys can read it, tells us how he raked in 2,400% in 5 days as the coronavirus and oil hammered the market. So there is, you know, I read the article, and basically, Dan, do you want to comment here on what he did? This article is about how he leveraged the VIX and was able to profit.
Yeah, well, I have not gone into the article in detail, but from reading this, I would assume that what he had were some VIX call options, or
that's what they were. VIX call options. That's what I'm going to talk about.
Oil futures. Yep, and a VIX call option, as you know, profits as volatility, the VIX index increases past a fixed point. So, you know, if he had a VIX call option just out of the money, and we see this all-time high movement through that ceiling, his profits are essentially unlimited to the upside. So the higher the VIX went, the more he was going to profit in this case.
So VIX call, meaning he bought a VIX call option out of the money, which is, you know, higher than where the price was when he bought that option. What I'm going to talk about next is bull call spreads, which, you know, what they're about is there is a limit on how much you can, there's a max profit, but what's beautiful about this approach for short term is that on the downside, you know, you're protected too, because there's a max loss too. Yes? And Dan, I want you to be on me with this, because everything that I'm sharing with you here is what I learned from Dan. And you have an opportunity to learn from Dan too. I like being on this call with these brainiacs that you see here, Joel and Dan, because I want to show you that a person like me can take what they're all about and make it work for me. I can sleep at night knowing that my portfolio is protected with every single thing that I learned from Dan and Joel, okay? So, coronavirus movers. I have some companies here on the screen that have been seeing some movement. Joel, you know, you want to, if you want to talk about P&G, I looked at Blue Apron today, which is the food delivery service. They were up 78% at the market open. 78%. Kimberly-Clark, paper company, okay? What can't we get enough of? Toilet paper, right? The shelves are bare. And then of course, Zoom, what we're using here for this communication. And Zoom, as I was saying earlier, is seeing such great volume. Joel, you know, our videos aren't being processed the way they were being processed previously, because so many people are using Zoom. So here's a chart of Zoom that I took a picture of last night. And you can see that, you know, at the low side over the past month, they were at 95. They were as high as 125 on March 5th. I think that was the day that was that the 3,000? That was an up day there on March 5th. So the point that I'm making here is Zoom is sort of in the middle of their low and their high. And if I'm someone who uses this product and loves this product as I do, I have an opportunity to put my money where my beliefs are. And Joel is big about this, right? You want to believe in what you're investing in. So what I just want to present here, very high level, and this is something that we're going to go into in detail if you choose to work with us after today, and we're going to make it super, super easy for you to learn with us. We're going to offer you a low price option to learn with us and start practicing what it is that I'm putting on the screen here. So I showed you the chart of Zoom. Where they are currently. That was as of last night. I'm not sure where they are right now, but I want to introduce the concept of a bull call spread. So in chat, and maybe guys, you can look at chat while I'm speaking, please go into chat and tell us whether or not you've ever put on a bull call spread. So in the chat box, bull call spread, let us know if that's something that you've done. And guys, if you see anybody, what they're,
I'll keep an eye on I'll keep an eye on the chat.
Keep an eye on that. So a bull call spread is a way for me to, in a short-term period, profit from something that I believe in, and also minimize my loss should it go the other way. So the max loss in a bull call spread is what I'm paying, right? My premium that I'm paying. So times 100 times the number of contracts. The max profit is the call spread width minus what I paid times 100 times the contracts. And then my break even is the lower strike price, okay, plus what I paid to get into the bull call spread. Oh, and I have sped there. It should be spread. I have a little typo. Dan, am I good? Is there anything you'd add here?
Yeah, so far so good. I mean, I would just add that, you know, guys, don't feel bad if like this is all new information to you. Like we build you up from square one in this course. This is core, you know, every mentorship that we engage in first starts with a personal assessment of where you're at, so we know where to start with you. It's not a one size fits all. So
thank you.
Breathe. You're good.
Okay, breathe. We're good. But we want to show you this. So I did a little comparison between if I did what I would normally do if I didn't understand options, and I just went and I bought 10 shares of Zoom for 1,100, okay? If Zoom goes to 120, I make an $8.90 profit per share, right? So if I bought 10 shares of Zoom, I'd make an $89 profit. $89 over 1,110 is an 8% return, right? But if Zoom goes to the low of what we saw for the month, I would have lost $147. Okay, Dan, are you following me? Yeah?
Tracking.
He's piloting me on this. So basically, my loss potential here, you know, looking at the high and the low of the month, is higher than the profit potential. All right? Now, if I consider doing a bull call spread, in this scenario, Zoom's at 111 last night. If I looked at the low strike of 115 and the high strike of 120, I would buy the low strike and I would sell the high strike. And again, we're going to teach you how to do this. We're going to teach you how to look at, think, or swim, and how to look at strike prices. And I'm looking at the May contract, by the way. So my max profit in this scenario would be the spread minus the debit. So at expiration in May, if Zoom is over 120, I would have an opportunity to make $3,500. That's a 233% rate of return. Dan, I'm good, right? Yes? My break even is at 116. Okay, so as long as Zoom, you know, goes up to 116 or higher, I'm good here, right? So my potential profit is 2 times whatever my potential loss is in this scenario. So just looking at what we look at when we do these analysis situations, this is what we refer to as the risk profile of this particular trade. So you can see my trade at the bottom. A bull call spread is referred to as a vertical, all right? So I'm just showing you a scenario on April 2nd. So let's say I hold this until April 2nd. This particular scenario, if Zoom is at 120 on April 2nd and I don't hold the contract until May 16th, I have an opportunity to make $530 on a $1,500. I'm tying my, that's $1,500 this cost me. You can see that at the bottom of the screen. It's a $1.50 debit, right? So if I bought 10 contracts, that's 10 times $1.50 times 100. So this would have cost me $1,500 to make $530. And that's a 35% return in a very short period of time. Super cool. You think that's cool, Dan?
I love this stuff. I would just add that these two lines here, you see a blue, like kind of like a teal blue, and then a purple. The teal blue reflects the options price at expiry. Okay, in this case, May 15th, right? And that purple line is, Dawn's referring to the April.
The April, yeah.
So
I'm going to do a stop share on this so I can look in the chat box. Please, everybody who's here, the people who are here, can you type in the chat box and tell us, number one, whether you've ever modeled a trade like this before, and number two, if you think it's exciting to protect yourself. In this scenario, we're protecting ourselves. We have a max loss. The max loss is $1,500, but the max opportunity at expiry, if Zoom is at 20 or above, is $3,500. So please type in the chat box and tell me what it is.
Lauren's raised her hand.
Yeah, okay, Lauren, I'm gonna unmute you. Okay, so more. Yes.
Yeah, I think I raised my hand a while back just to say that I was here.
I'm sorry.
Yeah, that's all right. I just typed in that, no, I haven't done this type of trade myself.
Cool.
But it's something, Dawn, when you and I talked, like 10 years ago, I opened up a TD Ameritrade account wanting to learn this stuff, but life got in the way and I just didn't do it. So, now is now.
Well, there's no better time than now. What's the
Right.
the Japanese proverb? What's the best time to plant a tree that you want to enjoy the shade of? Well, 10 years ago, but the second best time is right now.
Right.
Yeah, and Beverly, who is my accountant, she's on the line, and she is a brilliant financial person. She's saying strategy is exciting and it makes sense. It makes sense. So we're, and I explained this, okay? So this is something that I wasn't doing just a short period of time ago. So although we have, Dan and Joel here, these brainiac guys who've run hedge funds, I'm living proof that you can learn this and profit from this. And we're going to hold your hand. We get you and we've got you. So we get you and we've got you. So we're going to hold your hand and get you super comfortable doing this. So you get to the point that I'm at right now. And, oops, let me end the show here. I'm going to take a look at what's going on in my account right now. I'm not showing my screen, but we have, in a day where we're seeing the Dow right now is down 7%. I have a portfolio that I put on Monday where I'm the P&L since I opened up this portfolio, which is a protective portfolio where I have 3 NASDAQ options, they're bull call spreads, and 1 bond option play. I'm up $2,000, and this was a $2,000 in a $25,000 portfolio today. So guys, what is that? What's $2,000? My rate of return in 2 days on this portfolio that I'm talking about, that we're gonna show you. Where's my calculator? And
It's 8%.
How much?
8%.
8% in 2 days. Okay. So all of you may have had financial planners in the past that have told you in situations like this, write it out. I'm here you know, and we're here to prove to you that you can be actively working strategies during this time when people are just seeing their accounts go down, down, and down. That will help you recover some of the losses that you're seeing. Yeah, Beverly says the strategy is exciting, 128% annually. That's what we were talking about earlier, you know, but yeah, you can do this. So I'm going to hand the screen over to Dan. John Abato, give us a text us in the chat area here. What are you thinking when you're seeing this? Can you believe that this telecom rep has come all this way to the point where we're understanding how to protect and grow? So Dan, I'm going to hand it over to you.
Yeah, sure. I mean, and I want to just add one quick thing, one point about leverage. So options employ leverage, right? Futures employ leverage. There's other, you know, many tools you have at your disposal that will cover that employ leverage. And an interesting point to note is that banks and funds and big money actually employs more leverage during downturns like this than in normal situations. I'm going to show you a quick example right here. It's on my phone. Can you read those numbers, or is that just completely
Oh, no, we could kind of read it. We could kind of read it.
Put a quick futures trade on today, 2 contracts, $4,000 in, you know, this morning, just real quick. You can see P&L, you can see unrealized P&L, unrealized P&L. You can see that. Can you see it?
Sort of, but
take my word for it.
Listen, I saw Dan make, and I made $200 and he made $1,500 because we had different contract signs the other day. But yeah.
And we're going to go into that, and we're going to go into that just right now, actually.
Okay.
You know, our quick little six minute. Let me share my screen. Our 6 minute, $1,200 futures trade that we did the other day on Monday.
Joel, did you want to say anything before Dan?
I was just saying Dan might want to keep his mic closer to his mouth because
sure thing.
For me it's a little bit hard to understand.
Okay, yeah, keep that mic close to you now.
Sure thing. I'll hold it here. Share my screen. Am I sharing? I'm not sharing. There we go.
Yeah.
Sharing.
I'm not seeing you share.
Screen.
Share.
Sorry, guys. We're still working through the kinks here.
Oh,
right, can you see this? All right.
Okay.
So I'm gonna talk about a few things. My name is Dan Gasparini. Options for Wealth, and we are going to get right into this. Just real quick, when we talk about the market volatility index, the ticker on that is the VIX.
All right. So we're still seeing the covers slide.
Yep.
Okay.
VIX. Today we're going to cover the basics. I'm going to skip through Theta Delta Vega because it is going to be more applicable next week, but you guys will have this slide. You know, we're going to give you the slide deck so you can review that on your own. I'm going to talk about VIX Central, which is a nice resource that I use, and in general, the options pricing model. Then we're going to go into our quick little 6-minute trade and the VIX trade that I put on with the April 7th quick little expiry. I look to make about 30% or so on that trade by April 7th. So let's get right into it. Same legal slide as Don. I'm going to be showing you trades. If I've showed you a trade, I've taken that trade, and that does not mean that I am recommending this trade, right? I can say all day that I'm doing this, and I have, and I do, but the second that I start to say you should do this, that becomes an issue. So that's why I don't say that. The market volatility index. So we talked about this a little bit at the beginning of the call. The VIX is
I'll tell you what it is.
Market index. Yeah, it's a real-time market index that represents the market expectation of a 30-day forward.
It's 76 right now. It's 76 right now.
Yeah. So what does that mean? So when I say, you know, a 30-day forward-looking volatility, it reflects the demand for out-of-the-money puts and calls in the market within the next 30 days, largely moved by that. So what does that mean? So it means a high VIX, which we're currently at, which means that, you know, big money investors, the majority of investors, like, you know, I'm not talking Joe Schmo investor, you know, I'm talking Merrill Lynch, you know, is anticipating a sharp market moves one way or the others. If you're buying calls or puts or both, you need a market to move to make money on that.
Okay,
so
microphone.
Yeah, you need money to move to make money on that. So remembering that in the world of options and specifically credit spreads, volatility is our friend. So people are very afraid of volatility in general because 98% 7% of investors have a 401k and they're long only. So volatility is bad for them. Volatility is great for us options traders. So I'm going to show you how I'm evaluating volatility on a day-to-day. This is part of my daily routine. I'm going to look at this website every single day when I open up my account. It's called vixcentral.com. It's in the bottom right corner of the screen. I encourage everybody to write that down. What it shows is the VIX term future structure on the homepage. And you can see on this, I took this screenshot last night, but it was at 75 at the time, the current VIX. And then you see a downward sloping curve, right? 65, 51, 44, 38. Now, this is called a market that is in backwardation, okay? What does backwardation mean? Well, typically with options pricing, the fundamental principle of options pricing is that there's going to be more volatility next month than this month. And there's going to be more volatility 2 months from now than 1 month from now. And there's going to be more volatility 3 months from now than there is 2 months from now, and so on and so forth. So 95% of the time, this curve is actually sloped the other way, right? April would be the lowest point, November would be the highest point, and that would be how you would make money selling options, right? Remember, when you're selling options, what you're effectively doing is selling insurance to the money, to the market, okay? So, and we're going to go into, I'm not going to go into credit spreads today. I'm probably going to save that for next week, but I want to make everybody aware of this resource. It's a fantastic resource, for like selecting if I'm going to do a credit spread should I do it with an April expiry or a May expiry or a June expiry? Well, if I'm looking at this, I would probably say June or July would be our best bet, because after that you see the curve sort of flatten out, which means that your premium that you're collecting will be lower. Again, a little bit more of an advanced topic, but I wanted to make it into this presentation because it's very relevant currently.
Yeah, we want you guys to understand this, and we're going to give you an opportunity to learn with us.
This is a very wordy slide. In respecting everybody's time, I'm not going to go through it. I just wanted to put it in here so you guys have it. There are many more Greeks. These are called the Greeks when it comes to options trading. There are many more Greeks that actually affect the underlying price of the option. But in evaluating a trade, these are the three main ones that we look at. Delta, or direction, right? Do we want it to go up or down? Price, the underlying price. Theta, time. Again, in credit spread world, theta is our friend. And vega, volatility. Being currently through the roof, we're going to use different strategies with a high volatility than we would with a low volatility. And again, that was the 10-second overview of it, but you guys have this just as a resource. So let's look at our Monday. So Don and I got together on Monday, as we're going to do Mondays moving forward, and start to bang out some trades. And I put on 2 trades on Monday, effectively 3 legs. I have a little screenshot there. My favorite one, the one that we were talking about, was a 6-minute, 19-second trade where we made $1,212.50. So, if only I could do that every 6 minutes, right? That would be fantastic. But, in essence, what I had done there, and I alluded to this a little bit early in the call, was buy a futures contract. Now, a futures contract
for the S&P 500.
So yes, for the S&P 500.
So what ES and the current, so when you join us, we're gonna teach you this. There, you have an opportunity, if you have a futures account, right, to trade what we trade, which is the mini S&P 500 contract. There's also a micro product. And what that means is you don't have to have a ton of money in a futures account to start doing this. The micro product was just introduced last year.
Yeah, no, exactly. So, and we have, and there's different, you can trade futures on any major index.
Oil.
You can trade on oil, on soybeans, and anything. But I like this one. This is typically one that I use. I've been trading for about 10 years, and I trade one thing, right? I mean, that's, that's my mantra, is like, keep it simple, right? Trade the S&P 500 and the variance of that, as well as the volatility indexes that are tied to it. But anyway, you can see here, we got in at 2404.50. We got out at 2428.75, $50 per point. And voila, we have our $1,200 in 6 minutes and 19 seconds, so hooray for that. But I wanted to show you this VIX butterfly, right? I'm going to go into a lot of detail on, that futures play at another time, because again, we are tight for time, and, talk about like why I took that trade. But let's talk about the VIX one, because that's one moving forward and is still at the point where it's valid for entry. So we talked about the volatility being at an all-time high. Where's my mouse? At an all-time high. And this is the VIX. So, and again, this is delayed data. This is just a dummy account I use for teaching.
And that's how that Robin Hood guy made all that percentage, because he was able to get that upside that you see on the screen.
Yeah. Do you notice anything about the screen? It seems like we're on Mars right now with the VIX. But looking at the actual pattern of the VIX, like on a daily chart, I'm going to ignore like the recent swing. But how the VIX behaves typically, over the last several years, is that it'll peak. There'll be a market shock. The VIX will peak. Remember, the VIX is like, think of it as like the scaredness index of the market. It's how scared money is in the market. The VIX will peak, and then it'll fall down pretty quickly. And then it'll peak, right? And it'll fall down pretty quickly. Peak, fall, peak, fall, peak, fall, peak, fall, and then peak. So, in accordance with this pattern, what do we think is going to happen? Well, the play that I've outlined is that, well, realistically, for the VIX to stay this high, if the VIX stays this high for the next 3 weeks, God only knows where the market's going to be, because it's not going to be up. I'll tell you that much. For the VIX to remain at this level, we need to continually have this type of 10% down day, 3% up day, 10% up day, 15%, 12% down day. That's where the market has to stay. And, the thought process behind this trade is it's not going to stay there for another 2 weeks. It just can't. It's going to run out of gas. So the thought is that the VIX will fall down into this little zone I've outlined here between 60 and 35, okay, by April 7th, because that's the April 8th, because that's the expiry that I have selected. And it shows, it reflects this little picture here. Now I put this on Monday. Current VIX is up here somewhere, right? We're on 82 or something like that. So it's up about $800 or so right now. But the idea is, as we move time forward, and you see that purple curve start to shift, that, we're looking to be in this area really between 70 and 40 in the next 2 weeks, okay? And if we are in that area, with, in this case, $3,100 of max risk, we can profit up to about $5,000 on the trade. So that would be about 140+%.
By April 4th.
By April 4th. Yeah.
But if you hold that to expiry, it's a whole lot more.
Absolutely. And there's ways to manage yourself out of a trade like this, right? Hey, if I'm sitting over here, right, and it's April 4th, I'll probably realize half my gains and let the other half ride. I'm not an all or nothing guy. I do like to ring the cash register whenever I can. So just a little mentality, psychological side of trading. Dawn does a great job covering that. Psychological side of trading. But can you hear me now? Can you hear me now?
Can.
Cool.
Yes.
But anyway, if you guys want to take a look at that, take a screenshot of that, feel free to model it up and follow along. I got in at 310 per contract. Remember, this is a butterfly, so that's what it looks like. We're going to buy 10 puts here. We're going to sell 20 in the middle, in the peak of the butterfly. We're going to buy another 10. We're going to teach you all the shapes, guys. Don't worry.
We're going to teach you all of this. And also, if you don't have a Think or Swim account right now, one of the things that I want you to do today, the exercise, is to set up a demo account. You don't have to fund it, correct, Dan? You can start doing simulated trading on Think or Swim.
You're right. Yeah,
so start having fun and start doing these things. Dan, if you want to show that screen again so everybody can take a picture of that trade, but open that up. And we're going to offer you an opportunity to be live with us and show your accounts and put these on and simulate these and see the money, monopoly money, change hands and get you super, super confident around everything that we're telling you. So when you're ready to start doing this, you have that confidence built in. And yes, all of this that we're going to talk to you about, I'm going to hand it over to Joel now. If
Yep,
you could
I'll stop sharing.
showing the screen, stop sharing the screen, is yes, part strategy, but more than anything, and this is what Joel's expertise is, that prosperity mindset. So anybody, before we go, can you in the chat, before I hand it over to Joel, in chat, tell us what you thought of Dan's butterfly trade and the high likelihood that we're going to see that VIX index, you know, within that range in a couple of weeks. I've been studying and listening to all the market experts out there. I have, you know, several subscriptions, and, you know, the sentiment is that steam will be released and we'll see some kind of relaxing there. But again, there's,
Yeah, I mean, maybe the markets don't make it the whole way back. Yeah, I mean,
we're minimizing our risk.
Exactly. We're not saying the market's going to make it the whole way back, but we're going to say they got to settle down at least a little bit. Really, that's kind of the play.
And this is what I want to say about options. Everybody thinks that, oh, options are so risky. Options are less risky than being in positions, because if you're in a position and you're not in it with a stop loss, and sometimes those stop losses can, you know, you can go through the stop loss, you can go to zero, right? I was on a call today, and, you know, there's so many Boeing, look at what happened today. Boeing, Joel, did you see Boeing today? I mean, things are going down, down, down. But when you are in an options play, you already have set your minimum, your maximum loss. And that's what's so beautiful about what we're showing you. So Joel, I'm gonna hand it over to you. If you wanna unmute, if you have a screen to share, whatever that's all about. Are we having fun? I look forward to this every week, because I look forward to getting some more people excited about this. And I made a commitment this year that I was going to touch 100,000 people, and I was going to turn their fear into fuel with them. And there's no better way to turn fear into fuel than to align with people like us, who are going to teach you new ways to be in your money, so you have more confidence and you can take the action that's going to have you protecting and profiting. So Joel, take it away.
Great, thanks, Dawn. So first of all, before I begin, you guys know I'm all about mindset. So I would recommend saying this affirmation every day when you wake up, even when life is difficult or challenging, especially when life is difficult or challenging. The present is an opportunity for us to learn, grow, and become better than we've ever been before. So hopefully you get that.
Even when life is difficult and challenging.
Especially when life is difficult and challenging, the present is an opportunity for us to learn, grow, and become better than we've ever been before.
Opportunity to learn, grow, and become better than ever before, right?
Exactly, yeah.
So here's the deal. That's what we're doing, right?
Absolutely.
That's what we're doing. Learning, specialized knowledge, think and grow rich.
Yep. So I also wanted to say, as I don't have a slide on this, but everything I'm talking about today is not a recommendation to buy or sell. I'm all about education. All I do is teach. As a prosperity coach, I teach you how to do it yourself, which is actually rule number 8 in the 9 money rules millionaires use, my recent bestseller. It's available on Amazon. So so let me just share quickly a couple of things here. So this is me. You can reach me here. I just wanted to give you a little bit of my background first. What I'm going to be talking about is hedging today, and what Dawn and Dan were talking about is hedging as well. And as some of you know my background, I worked at FSI as an analyst at a hedge fund. I also worked at Citi as a hedge fund manager. At the peak, I was managing $700 million. During the financial crisis, I was managing $300 million. So I'm quite familiar with this kind of volatility that Dan and Dawn have been talking about. I also had my own hedge fund, which I managed a long short portfolio. So I'm all about hedging, right? So there's abilities to make money in up or down markets. And that's what I teach people, right? So that's what Dan showed you in those strategies, those option strategies. Dawn showed you as well. So it doesn't have to be just option strategies as well. So let me talk a little bit about hedging by buying and shorting. So what you're doing when you're shorting is all you're doing is betting that stocks are going to go down. When you're buying, you're betting that stocks are going to go up. So when I was managing my hedge fund during the volatile times of 2008, the market was down 40%, 40, which is not far from what's been going on the last month. Financial stocks were down 57%. So even more so, all I was doing was managing financial stocks, and we were able to make money in 2008, a small amount of money, but no downside, and we were managed to make a few percent while hedging. So betting some stocks were going to go up and other stocks were going to go down. So in this environment especially, I believe hedging makes a lot of sense. You can do it with options, you could do it with individual stocks. And this environment, there's, I'm also in my bestseller, 9 Money Rules, I talk about choosing faith over fear, right? And Dawn mentioned my emphasis on beliefs, which is the #1 rule in the 9 Money Rules millionaires use. So I recommend, learn all this stuff, but also have, figure out what your belief level is, right? And if you're have massive fear about the stock market or options, let's educate you first, get your belief level up so that you're going to make money. When you know you're going to make money, I will tell you, you're going to make money. When your faith level is 7, 8, 9, or 10 on a level from 1 to 10, and 1 is massive doubt and 10 is absolute faith, that's when you're making money. And so there's opportunities to make money every single day. Another great affirmation I recommend saying every day is lucrative opportunities always come my way. Lucrative opportunities always come my way.
I say it every day, Joel. Every day.
And so just because the market's going down doesn't mean there's not lucrative opportunities. Let's see if I can let me go back to another screen here. Let's see if I can share my
All right. In the chat, can you guys please tell me how much you love my brainiacs, my men? My men. Do you love my men? Give me some love in the chat and tell me how much. I introduce you to all the most awesome people. Beverly said that you guys are awesome. Thank you for the love. I love my men.
You guys see my screen?
I love geeks. Lauren said she loves geeks. Yes, me too.
You see a lot of red on the screen, but top stock here is Zoom, which is up 3% today. You see a lot of red, but Zoom's up 68% this year. So what we're talking about here, hedging, is from my point of view, you want to be looking at conservative companies, thinking about the macro environment that we're living in right now, and think about safety. And that's what you want to invest in, like safer companies and trends. So Dawn talked about Zoom. So Zoom could be one potential long opportunity. Safe companies like Berkshire Hathaway, which have invested $170 billion in cash. And they're going to be, Warren Buffett's going to be buying a ton of companies over the next weeks and months. I'm not sure if it's going to be next week or next month, but at some point he's going to utilize that cash to take over high quality companies like we're talking about doing. You can buy Berkshire Hathaway just over book value right now. Maybe it's about 1.25 or 25% of premium to book value. It normally trades close to 2 times book value. So that's one, again, I'm not making any recommendations. You guys do your own homework, but think about trends. The one stock I wanted to quickly mention, and
Beverly, by the way, said she bought it yesterday.
oh,
Smart
good
lady.
timing. Yes. So this is the FactSet system, by the way, which I use on a daily basis. So this is an insurance company called Mercury General, and they are an auto insurance company. Now, think about auto insurance right now, and not a lot of people are going to be driving far distances. Maybe they're not driving much at all in the next few weeks or months. Who knows? Hopefully things change dramatically, but definitely in the next couple of weeks, there's going to be much less driving. And yet, you're still paying your premiums on your auto insurance policy. I'm pretty sure that's not going to stop for the next few weeks. A lot of people have 6-month or 12-month policies even. So they're getting their premiums, and losses are going to drop pretty dramatically over the next few weeks and months. So they're going to have a very good quarter. But what I do is I do fundamental research, and I look at my 5-step stock screen, which is in my recent book, The 9 Money Rules Millionaires Use. So you can get it on page 152, 153 there, but I'm just going to go through it quickly here. So this is a company. So what the first step is to look at earnings for the last quarter. Compare it to the earnings of the prior year. So they made 57 cents. If you guys can see that. Is that big enough?
Yeah, I see it. Earnings per
Okay.
share, 57 cents.
57 cents. And last year they actually had a loss. So that growth is actually infinite. Okay, so they grew their earnings from 57 cents from a loss. So you want to look for companies that are growing their earnings. And then the second step here is to look at revenue growth. And here the revenue growth was 973 divided by 890. So that was actually about 9%. I'm looking for companies that are growing their top line at least 5%, their bottom line at least 10%. In both of these cases, that's true. And the step 3 is I want to find companies where the bottom line is growing faster than the top line, which means that their operating margin is expanding. That's true in this case too. The next step is to calculate the PE, or the price to earnings ratio. So if I were to multiply the 57 cents times 4, that's an annualized earnings for that quarter, you get $2.28. Stock's trading at 36. So it's about 16 times earnings. We already saw that this earnings growth is infinite. If you're growing from a negative to a positive, it's effectively infinite. But let's look at the forward PE for Mercury. Here's a quick snapshot. Again, I'm pretty sure the analyst estimates have not taken into account that their losses are going to drop dramatically this quarter and potentially next quarter. So they're supposed to earn $3.23 this year. That's 11 times PE. Again, and then if you look at the earnings growth forward, 323 versus 260, that's 24%. So you got a company growing faster than the PE, and the PE is probably, the earnings are probably understated, the PE is probably overstated. And the last step, I look at the last earnings report to see how did the company do during the last earnings. It looks like they had a really good earnings, but how did the stock price do on the last earnings report, which was actually February 10th. So the stock was up 9.7% that day. 9.7. So analysts and everybody who was invested in loved that stock price, that earnings report, and they reflected in the stock price. So the company passed my stock screen. Of course, it's down massively, like the whole market is. You see here, it's down from 53 to 35. We could go back a little bit further to see how cheap this stock really is. It's down to its lows in 2011.
Wow.
Right, 2011. So again, not making any recommendations here. I'm just saying that this could be a potential long. And then what are shorts, right? We already talked about the VIX. I mean, okay, what's the upside to downside versus for the VIX? Maybe it goes from 85 to 100. I don't know, it's unprecedented, but can it, so that's up 15, but what about, could it go down 50? Easily, right? We were at 35 on the VIX just a couple of weeks ago.
Well, where we're in February, I think on February 19th, I think, where were we, Dan? At 12, right?
Right.
Yeah.
Yeah, so the upside downside versus the VIX. So think about the macro environment. There's a lot of things going on which are not good. There's plenty of shorting opportunities in different types of stocks. You know, who knows, there may be a bailout of the airlines, so that could be a positive. But there's, you know, think about energy companies. There's a lot of sectors, travel. A lot of these companies have gotten hit really hard already. You know, we're gonna have a few more weeks of this for sure. And the question is, you know, what is the earnings of those kinds of companies? Here you have a company with Mercury that earnings are protected. There's a lot of industries where earnings are going to drop pretty dramatically quickly. So that's the point of hedging, finding stocks that you think are going to go up, other stocks are going to go down. And so even if the market's going down, you're protected.
Yeah. And that's just so, you know, I was talking about my portfolio, the hedge portfolio that I put on Monday, and what that's looking like. Yeah.
Yeah, so the final thing I just want to mention is short interest. So a lot of investors look at short interest. That's the number of days that you'd have to buy back the stock if you are short. And it's actually a very interesting measure, because if you have companies that have 10 days to cover, 15 days to cover, if the professional investors, what's going on a lot right now is professional investors are taking the money off the table. So the short interest is going down. If you find companies that have very high short interest, they're probably good longs, because people are covering their shorts, selling their longs, getting out of the market. And those companies that have very high short interest are good potential longs. Everyone's already shorted them already. So I've seen some strange moves over the last 2 or 3 days, and then I look at short interest and I'm like, that makes sense.
We just got a circuit breaker. The market right now just shut down. Okay. Circuit breaker. So
that's all I wanted to share today. Hopefully that was helpful. You guys saw my say again?
Amazingly helpful, all of you guys. Yeah.
Thanks.
So what if everybody's we have a group here, we have the attendees here in chat. If you want to unmute yourself, I'm just going to take us off of I'm going to just stop recording so you can feel comfortable. If you want to